Gurmeet Chadha joining in, Managing Partner and CIO at Complete Circle. Gurmeet, great to have you on a good Tuesday morning at least. And we just put out that data point that Indian markets seem to have erased all of its losses since the April 2nd tariff announcements or the tariffs came into impact. The question now is this a temporary relief that we're seeing, or is a sense now settling in that the US president is going to go back on some of these tariffs, that the pain isn't going to be as bad?
Hi, Taman. I think bit of both. I think it's some pause, but with US president, you can't always be 100% sure what is coming. There is a bit of a flip-flop in a lot of announcement the trade representative has done, including the pause on tariffs. But it's a bit of a pause, and I think some point of time markets will realize that we are not uniquely disadvantaged in a lot of pockets. So let's say, for example, auto. So if you are at 25% along with steel, aluminum, and other products, your peers are also at 25%, or in some cases like China, more than that. In some cases, you've got some exemptions, including the recently announced electronic parts, chips, computers, etc. And then you have pharma, which is still not touched. Obviously, there's a lot of noise around it. I think what is important is to understand that how domestically we are pivoting and start building there rather than focus on these developments, because they are completely out of your control. You will only react to it. So, for example, RBI has pivoted meaningfully. So it's not just the rate cuts; it also the liquidity infusion, and they've clearly said that 1% of NDTL is where you want to be liquidity positive. So very clear communication there. They have reversed risk weights on MFIs and NBFCs. They want capital flow to capital to flow more freely. They've done some changes in PSL as well, so that the credit reaches more to the broader end. More changes in co-lending too. So I think that is where I think we need to focus on. And what I've seen over a period of time is that every reversal has a different set of leadership. So nobody in 22, 23 thought it could be PSU and defense leading the pack. Similarly, now I think you probably need to focus more on domestic and domestic consumption to figure out what lead next as and when the market stabilizes.
Gurmeet, hi, morning, Alex here. I know that you guys track mutual fund flows also very closely, and of course you've got quite a few clients and you understand the pulse as well from that perspective. But I just want to draw your attention to the fact that 11,000 crore practically was deployed on a net basis into ETFs last month, and you had despite the fact that you had a low in terms of active equity, there was a considerable amount of deployment in small cap and mid cap as well. I'm just wondering, based on how you see investor behavior, now that the tide is turned, do you see a more durable flow? And of course, that temporary negative SIP number, does it reverse? What does that mean for the equity markets going forward?
See, Alex, if you remember in COVID, the SIP book dropped from, I think, 8,200 crores to 5,500 crores. If my memory serves me right, that was almost a 30% drop. And this time it's been just about steady at 26,000 crores. I'm talking about gross numbers. Obviously, the net numbers are 12 to 14,000 crores because there are SIP stoppages, bounces, SIP expiries, NACH registration fails, whole host of issues. There have been some stoppages in SIPs too, but that's mostly on new age platforms where there is no physical face to handhold you. So because in these times like this, you need a personal touch. The algos and robo advisory won't help you. And that's why I always say this business is more phygital and needs a personal face, and there's a famous quote, personal finance is more personal than finance. So I think the flows have been pretty steady. In fact, we've been actually getting some flows at lower levels, and that shows some bit of maturity in the market. We don't have any negative net equity sales. I think that would be the first red line. The net sales have reduced, but we are still clocking about 10,000 crores of net positive sales. And I think that's a very healthy sign. And I think the SIP book is only going to grow from here. So I don't see flows as a yes, there is passive picking up. Also, there's a lot of factor-based funds picking up, which is momentum investing, low vol, high alpha. Mutual funds are coming up with a lot of innovations. There's been some innovation on the multi-asset side also, which is a combination of gold, silver, commodities, equity, and bonds with tax efficiency and bit of financial engineering and mutual fund. That category is growing very fast. In fact, that category may actually become as big as balance advantage as a category. So I think it's asset allocation fund and some passive funds which are seeing flows, which is normal in a volatile environment. And unfortunately, people had forgotten debt allocation and conservative allocation because of the massive rally. People had stopped thinking about that. And I think some rise in multi-asset allocation funds, hybrid funds is welcome for the industry.
Right. So that's with regards to, the mutual fund side of business. But Gurmeet, one point that you touched on is how important gold is as well right now. Now, taking the current volatility into consideration, we just read your tweet the other day where you clearly mentioned that from the current 3% or 3.75% of the world GDP that India holds, probably we are going to see an increase of almost $5 trillion, and this is by 2030, to reach almost 8% of the world GDP. So this tells you that, yes, the India growth story from a long-term perspective seems absolutely intact. But what should an investor do in the short term in terms of allocations? Because that's where the juice is.
Absolutely, and I always say this that pessimist always sounds intelligent, and the optimist makes money, and that's why asset allocation is important. So I think in the near term, as I said, it's very important to look at what are low hanging fruits. So I think this is a tough year, and I think anybody tells you otherwise, doesn't really know much. I think you will see a tough year, and that's why it's important to look at bonds right now. So we are currently at about 6.5% on the 10-year GSEC. RBI has changed its stance to accommodative. I think there will be 50 to 75 bips rate cut more, which means there is a scope for bonds to also soften by another maybe 50, 60, 70 basis points. So long duration bonds, in my view, still make sense. You will get 6.5 on as a running yield, and you'll probably make 4, 5, 6% as mark to market gain with some volatility. So there is a good likelihood of some double digit returns to be made. Corporate brands also will move, with some yield curve flattening taking there as well. Then there is a category I was talking about, which is bond plus arbitrage as a category, which is now a little more tax efficient after the change in capital gains. With capital gains being 12.5% uniform after 2 years there. So that's another category. And some allocation should go towards gold, silver, and commodities. I think direct exposure is risky because you don't really understand and not much options available in terms of X number of. You may still have a silver ETF, but you don't have most commodity ETFs. So multi-asset funds is a good category where you can take some commodity exposure. And when you have $14 trillion of money lying in US treasuries outside US, non-US money, some bit of capital flow will reverse from US. This US exceptionalism, which we are used to 10, 15 years, will see some moderation, which means money will chase commodities, golds, and other asset classes. And I think that is the reason that 5 to 10% allocation should go there if it's not already there.
Gurmeet, a lot of chuckles in the studio on your comment that pessimists sound clever, but optimists make money. And I suppose those who don't make money then feel more pessimistic. Very optimistic on HDFC Bank today. And what we're seeing with banks, interest rate trajectory coming in low. We're expecting a rough quarter for banks overall. But do you think that that's priced in and we could see the strength continue?
I'm optimistic on the bank since 2006. I joined, I left the bank. So, one good thing is that a lot of the banks, financials which were written off, look at Bajaj Finance, for example, 6,000, nobody was willing to touch it. At 9,000, everybody is optimistic. And that's what happens, which I was telling you, market will rotate on every pullback and different sectors take charge. So if the interest rate cycle is changing, the banks are realizing that, CASA will be difficult to get. So you have to have smarter treasury management, more razor sharp focus on liabilities. A lot of things will get changed. So HDFC's reduced CASA in saving rates to 2.75% now to offset the pressure on NIMs. They had a record deposit growth last quarter, which we saw in the quarterly update. And I think the bank has been on a bit of a range. If you take last 3-4 year returns, the returns on a fixed deposit on HDFC and HDFC Bank as a stock would be same. So I think I'm constructive on the entire financial space. Both NBFCs included. I spoke about how risk weights have also been reversed on NBFCs and MFIs for better flow of capital. So cost of funds coming down is actually a little more positive for NBFCs in the near term and more for banks in the medium to long term. So constructive on HDFC, constructive on ICICI. We also like Federal Bank. In tier 2 banks or a mid-tier bank, if you may call it. Change of leadership. I have a lot of regards for Mr. Manian, the way he's built Kotak, as a franchise. And they are now transitioning from wholesale deposits to retail deposits. The book is now getting more granular, and there's a lot of change, including Kotak. There is a leadership change now. A lot of issues and tussles they have with RBI, including on regulation, on leadership is behind. So I think this spot looks good to me, and I think probably bank would lead as and when we see indices, scaling up 10-15%.
They're definitely leading, Bank Nifty looking spectacular. But Gurmeet, the big issue with the BFSI space has been regulatory uncertainty, because you don't know what is going to come in right now. And we saw that with gold financiers, for example. Manappuram, Muthoot, suddenly waking up and saying, okay, there is a new set of regulations that are going to come on gold loans. How do you make space for that?
Yeah, I think you got to be, that's one issue with financials. You can just woke up one day and have an IndusInd Bank kind of an episode, one accident. And that's why I say banks with gold credit underwriting standards should be the core portfolio. Do not just get carried away by, high growth numbers or high NIM numbers and we've seen that with Yes Bank, we've seen that with DHFL. There's so many examples. And I always say that in banks, high credit growth, high growth, exceptionally high rates are a red flag. You should have more moderated growth, and that's why I say that, banks right now are sweeter, have a nice mix of secured, unsecured mix. So wherever you are seeing RBI sees any signs of heating up. So for example, it was IPO financing last year. They went after IFL, JM, and a lot of NBFCs on IPO financing. They saw some discrepancies in gold with both on purity as well as cash dispersal happening on gold fund. And now with, gold prices going up, at least the stress on default goes away, because people tend to lower the default because gold is used as a collateral. So I think any standardization is good, but any pocket which heats up, short ticket personal loans by fintech platforms, IPO funding, RBI will go after it. So go after, as I said, banks look sweeter. Look at, for example, entire Bank Nifty, despite this run up, is 13 and a half times. On a price to book basis, private banks are around two times, which is below actually their historical averages. So stick with winners, stick with gold standard, top 4-5 entities there, and do not try and do too much bottom fishing here.
You mentioned, Gurmeet, that the idea is to focus on domestic, right? And you've already talked about the banking space and financiers in great detail. I'm just wondering how else you would play it and what specific pockets you would focus on, because there's so much conversation, so much chatter on the domestic consumption story and whether FMCG is really going to catch up. How do you play the domestic consumption space? What would your picks be?
So Alex, I've, a very seasoned portfolio manager told me that if you're not tracking Gen Z consumption, you will miss the consumption bucket. And I think this generation, which is, 18 to 25, if I were to broadly put it in a group, is consuming things differently. And so they're not going to consume the typical BPC, which is beauty, personal care, and typical FMCG products the way we did, or millennials did, or some of our previous guys did. And I think the consumption basket to me is more travel and tourism. It is also financial products. To me, for example, CDSL or a CAMPS is also a consumption basket. To me, a new age e-commerce platform is also a consumption basket. So your consumption basket has to be slightly different. Maybe the food business would be a bit of an exception, because there we are seeing a movement from unorganized to organized. So a likes of, for example, a Tata Consumer may not fit in the typical FMCG category. So you need to probably change that. And I think there are very good signs. So rural consumption is showing signs with monsoon surplus at 7-8%. The crop has been good. I've been taking some feedback from my home state, which is Madhya Pradesh, on a lot of crops which are coming. And I think the rural is showing a lot of good recovery, and fingers crossed, that's a very good sign. We saw that in M&M commentary also on tractor sales. So some bit of it you can play through rural consumption names, which is some good two-wheeler names, which are more domestic, like TVS, some of the tractor plays, some of the travel and tourism plays. So your consumption basket typically may not comprise the same names which we are used to, and has to be slightly different.
Point. I do want, and M&M, by the way, doing particularly well in trade today as well, over 3% higher. That entire auto pack, in fact, in focus. But Gurmeet, the platform plays, a lot of people have tried to play this consumption story through these platforms. And I look at Swiggy, for example, that has lost so much value over the course of this correction. Do you think that it's par for the course? It was effectively equilibrium being sought, and do you think that that point has been found and that it's starting maybe to look attractive now?
See, I think you should play the new age business like VCs do. It's just spread your bets. And sometimes it's a bit of a term, you spray and pray, right? You make a new age portfolio because here there are a lot of things which are binary. It's a hero zero trade in a lot of cases, and that's why you don't want to be too concentrated. I'm a little more comfortable with Zomato while the valuations of Swiggy have obviously moderated, and there is a bit of a gap there. But I think, see, look at this way: they spent 12,000 odd crores in food delivery, in burning money in terms of setting up food delivery. They were able to do quick commerce with just half of that amount, right? So what I'm trying to say is once you have the business model in place, you can pivot, right? So today it is, for example, district, which is, you can call it the ticketing economy and out of home consumption play. You have Blinkit, which is the quick commerce play, and you have Zomato, which is food delivery. So I think, I was comparing the orders Zomato does versus Mitutuan and some of the bigger names in China. There's a 10 times difference. In Chinese food delivery apps do 4 or 5 crore orders a day. We are doing 25, 30 lakhs, and we are getting pretty used to it. So my sense is that you make a portfolio of, a Policy Bazaar, a Zomato, maybe Swiggy, maybe Nykaa, make some of the new age names there. As I said, to me of CDSL and some of the exchanges are also platform plays. And you hope that some of them really, make that 5-10x for you. Don't be over concentrated on one because, these businesses are prone to disruption. And that's how you make the portfolio. Don't concentrate your bets and don't make it this versus that battle in this space.
Right, so that's with regards to the diversification that you need. Gurmeet, taking into consideration that we're just kickstarting earnings, we have TCS, which has already reported numbers. How are you looking at this quarter? Because the overall expectation so far is that it is going to be muted, and probably there could be a cycle of revival from here on. What is your key expectation? Which sectors could lead and which sectors will be the laggards?
I think that's the most important trigger, bigger than the tariff noise and a lot of things around us, because unless we fix our house in order, which is earnings, all this debate is meaningless. So see, if you are trading at 17, 18 times now forward, and if your earning growth again comes up mid-single digit, I think then the market will either correct or will more time correct. There is no way it can go up. It may move here and there due to euphoria on some news and other. So while I think Q3 had some signs that probably the bottoming out has happened, we saw almost an 8% growth in earnings after a very bad Q2. If we can deliver around 9 to 11% in this quarter with better commentary, and I think commentary is more important to me, I think markets will probably take heart. And that's why I said that unless the earning growth comes back to 15-16%, there is no point giving higher Nifty targets. So this is a year which is of consolidation. You have to really go level 2, level 3 to make that return and be a little more defensive in nature. Do not just buy stocks because they have corrected 40-50%, but they are still trading at, let's say, 50-60 times. And then that's the trap you need to be very careful of. So to me, that's the most important factor. And I would eagerly look forward to, I'm expecting around 9-10% growth in earnings. Let's see how it pans out. Non-financials maybe 7-ish, 7-8%, with financials probably early double digit. If that plays out well with better commentary, I think then you'll probably have a second half, which is a lot more
Gurmeet,
decent.
9 to 10% also, I think, is a tall ask, according to me, taking into consideration the market conditions, right? So which are the sectors which will lead to this 9 to 10%?
So I think financials clearly will report good double digit, and that's probably 1/3 of the index. And I hope IT doesn't see too much drawdown. So you also have to see what dragged the index. So it's not just about incremental earnings. And I think as I said, domestic consumption should do well. I think power and energy sector should report better earnings. We've seen peak power demand in February, almost 238 gigawatts, almost 134, 135 billion units. And I think the transmission capex is well on track. Government picked up expenditure in the last quarter. So hopefully your last GDP data would be also 7-ish plus. And if nominal growth is 10-ish, 10-11% this quarter, there's a good chance that earnings could be around that.
Okay, and how are you looking at the other domestic oriented players like, say, cement? Because the consensus view is that low double digits is the kind of uptick that could be expected in terms of demand, and it's mainly the price recovery that will drive growth for cement. Apart from that, if you see oil and gas, again, that is a segment which is expected to lag on a consensus basis. But how are you looking at both these segments?
Yeah, I think cement is slightly disappointed in last couple of years, considering the consolidation we have seen. So if you see now, the Ultratech and ACC Ambuja Adani Pact, that's slightly more than 50% of the market, and which was a very scattered market 5, 6 years back. So, you'll see probably some better pricing. I think in South, probably some 4, 5 rupees bag pricing has gone up, and there'll be a small improvement in volume too this quarter. So it'll be a combination of pricing and volume. And valuations, because of time correction, I think are a lot more reasonable. So any sector which consolidates, and then, pricing is better, typically tends to do better. And I think every country globally now would be more inward looking with the new regime here. So it's a bit of I would not say reverse of globalization, but inward orientation. Look at Germany, they did 500 billion euro of infra and defense spending for next 10 years. So, and there's a revival in housing and infra, government spending picking up. So I think demand environment is conducive. Pricing should be better, hopefully, and I think cement should do well. We like Ultratech in this space, and we're looking at some names in tier 2 guys, which could be good acquisition candidates, either for Ultratech or the Adani Pact.
All right, thank you so much, Gurmeet. Always a pleasure speaking with you, and especially on a day when markets are shining and banks more than ever. So I think the long call on banking has worked, at least for today, and could sustain. Thank you so much.